Hey, future CFA charter holders. Uh, I hope you're all feeling motivated and ready to tackle another exciting session. Welcome back to FinQuiz, your launchpad to success in the CFA program. Our goal at FinQuiz is simple, equipping you with the knowledge, strategies, and confidence you need to not just pass, but truly master your exams. So grab your notebooks, bring your questions, and let's explore together. Remember, every session brings you one step closer to those three coveted letters CFA after your name. All right, deep breath. Today, we're stepping into portfolio management, and this is where the whole investment story comes together. You see individual assets, stocks, bonds, real estate, commodities, each has its own personality. But the real magic, it's in how they behave together. That's portfolio thinking. So what we're learning here is the big picture. Instead of obsessing over one stock or one bond in isolation, portfolio management is about asking, how do these things work together? How do we combine them so risk doesn't crush us, returns stay on track, and the whole mix actually helps us meet our goals? That's the art and the science. Now, here's something you've got to know. Portfolio management isn't just some side topic. It shows up in level 1, grows deeper in level 2, and by level 3, it's the entire game. Which means if you build a rock-solid understanding here, you'll carry that advantage all the way through to the finish line. Let me put it this way. Think of someone, we'll call him James. James reads about a hot stock online, buys it, and prays. Sometimes he wins, sometimes he crashes. That's not portfolio management. That's gambling in a business suit. Portfolio management says, slow down, breathe. What's your objective? How much risk can you take? How long's your horizon? Only then do we build a portfolio. A carefully chosen set of assets that work together instead of fighting each other. Now, what's coming up in this module? We're going to start with an introduction to the idea of portfolio management, then move into the history of returns and risk, why diversification is your best friend, how to measure returns, portfolio variance, covariance, correlation, all the fun stuff. And don't worry, I'll make sure every formula is explained in plain English so it sticks. Okay? One more thing before we start. Don't dismiss this as just an intro. The CFA exam absolutely loves testing the fundamentals from this reading. Definitions, relationships, conceptual clarity. So the smarter you get with these basics, the stronger your foundation for everything else. Here's the big idea. Portfolio management is all about balancing return and risk. Two sides of the same coin. You want returns? Great. But you can't talk about returns without talking about risk. And the way you manage that trade-off is through the structure of your portfolio. Now, think of it like cooking. If you just eat chili peppers straight, that's risky. Too much spice, too much pain, but mix them in carefully with rice, veggies, and maybe some meat. Suddenly you've got a balanced meal. Same ingredients, totally different experience. That's what we're doing in investing. Mixing risky assets with safer ones, diversifying so the whole plate is tasty and sustainable. All right, let's kick things off by understanding what portfolio construction really means. This isn't just about picking a few stocks and hoping they'll do well. It's about combining different types of assets, like stocks, bonds, maybe even real estate or commodities, in a way that balances risk and return based on your specific goals. Think of it like running a restaurant. You don't just throw ingredients together. You craft a menu that satisfies your diners while managing cost, prep time, and consistency. Same deal here. You've got to evaluate the risk of each asset, the expected return, and how they all interact. That's the correlation part. The end goal? To build an optimal portfolio that sits right on the efficient frontier which basically means you're squeezing out the best return for any given level of risk. And the secret weapon in all of this, diversification. It's like having multiple income streams. If one takes a hit, the others can keep your business afloat. In portfolio terms, diversification reduces your risk without necessarily sacrificing return. And that, my friends, is how professional portfolio managers build smarter portfolios. So, folks, remember, one thing you'll see again and again, individual securities on their own are unpredictable. A stock can soar today and crash tomorrow. A bond might be safe most of the time, but inflation eats away at it slowly. But when you combine them intelligently, the ups and downs can smooth each other out. This smoothing effect, that's diversification in action, one of the absolute pillars of portfolio management. Now, here's where it gets exam relevant. The examiners love testing you on the relationship between expected return and expected risk. They'll frame it as an investor wants higher return. What happens to risk? Or which portfolio dominates? And your job is to recall that basic principle. Higher expected return almost always comes with higher risk. You'll be graded on whether you can interpret those trade-offs. Let's ground this with a quick example. Suppose you have a savings account paying 3%, very low risk, very low return. Now compare it to buying shares in a fast-growing tech startup that could return 30% or wipe you out. Portfolio management asks, how much risk are you personally willing and able to take? And how do we put assets together so that the risk is worth the return? And yeah, one more thing, portfolio management isn't just about choosing assets. It's also about aligning them with the investor's objectives and constraints. Time horizon, liquidity needs, tax considerations, ethical preferences, all these shape the portfolio. So when you see a question in the exam describing an investor with short-term cash needs, or a retiree, or a young professional, your brain should immediately translate that into portfolio implications. And just to help you visualize this, imagine you're an investment advisor. Two clients walk in. Client A is 25 years old, has a steady income, and says, I want to grow wealth over decades. That portfolio can lean riskier, more equities, less cash. Client B is 65, living off savings, and says, I cannot afford to lose money. That portfolio will tilt toward capital preservation, more bonds, more stability. Same framework, totally different allocations. And hey, before we move to the next section, folks, FinQuiz has these battle-ready summaries, perfect for revising the concepts efficiently. Honestly, they're a lifesaver when you've got only a few days before the exam. Concise, focused, and crafted to drill in exactly what the examiners love to test. If you're interested in getting the full set of learning modules, just check out the link in the video description. Take a look when we're done here. But for now, let's keep going. All right, folks, now that we've laid the foundation with an overview of portfolio construction, let's roll into something absolutely critical. Understanding historical return and risk. This is the backbone of investment analysis. And trust me, the CFA exam loves this topic. They'll test your conceptual clarity here for sure, so let's make sure it's rock solid. Now, let's start with the term historical return. What does that mean in plain English? It's simply the return an investment has actually delivered in the past. It's backward looking. Like if you bought a stock for $100 and sold it a year later for $108, boom, that's an 8% historical return. That already happened. It's fact, not forecast. On the flip side, we've got something called expected return. This one's forward looking. It's a prediction, a best guess based on all the info, data, and models we have. So when analysts say they expect a stock to return 10% next year, That's not a guarantee. That's expected return. Now, here's how we often frame that expected return. And I'm going to break this down like I would on a whiteboard in class. Expected return is made up of a few things: the risk-free rate, expected inflation, and the risk premium. So as you can see, this formula, expected return equals risk-free rate plus expected inflation plus risk premium. Now, let's make that real. Say inflation is expected to be 2%, and you want a 5% premium for the risk you're taking. Add those to the risk-free rate, maybe around 3%. And yep, your expected return is 10%. That's the kind of equation you've got to understand intuitively. Not just memorize, but really understand what it's all about. Now, notice that we're multiplying these three parts, not just adding them. That's because returns compound. Each component builds on top of the other. So if your real risk-free rate is 2%, expected inflation is 3%, and risk premium is 5%, the combined expected return isn't just 10%. It's actually a bit higher, about 10.3%, because we earn a little bit of interest on the inflation and risk premium parts too. That's why we multiply the terms instead of simply adding them. In practice, though, when the numbers are small, we often use the simpler additive version. It's a close enough estimate and much easier to work with on the exam. Now, one important reminder: expected return is not what you're guaranteed to get. It's just your best estimate. Actual returns can and will differ. The CFA exam loves to trip people up here. Don't fall for it. Expected and actual are not the same, especially over short periods. But here's where it gets a little more nuanced. Over the long run, the average of historical returns can be a good estimate of expected return. Think of it this way. In the short term, markets are noisy, emotional, volatile. But over decades, things tend to balance out. That long-term average starts to give us a signal. All right, now let's shift gears a bit and talk about risk. And this, folks, is huge. Risk and return always go hand in hand. You can't talk about one without the other. The basic idea is if you want more return, you've got to accept more risk. That's the trade-off. There's no free lunch in investing. If someone promises you high return with no risk, run the other way. So what exactly do we mean by risk? In CFA terms, it's often measured as volatility, how much an investment's return bounces around over time. More bounce, more risk. Let me give you a real-world example. Think about a treasury bill. That's considered virtually risk-free. Maybe it gives you a 2% return. Now compare that to a tech startup stock. It might shoot up 30% one year and crash 20% the next. That's risk, and because investors hate uncertainty, they demand extra return to take it on. That extra return is called the risk premium. So if the T-bill gives you 2%, and the stock is expected to return 8%, then the risk premium is 6%. That's your reward for accepting the roller coaster ride. And by the way, this risk premium is always calculated over the nominal risk-free rate, not adjusted for inflation. Just a little detail the CFA exam might sneak in, so keep that in mind. Now let's bring it all together. As a portfolio manager, you're not just picking assets randomly. You're looking at each one and asking, what's the expected return? What's the level of risk? And how do they all fit together in the big picture? And that leads us back to the concept of building a diversified portfolio. You don't want all your assets flying up and down in sync. You want some smoothing, some balance. That's how you manage the risk-return trade-off, by combining different assets thoughtfully. Okay, let's take a quick pause here. If you're watching this and thinking, this makes sense now, That's probably because you're looking at one of our FinQuiz Battle Ready summaries on screen right now. These summaries take everything from the CFA curriculum and strip it down to what really matters. If you haven't grabbed them yet, go hit the link in the description. They're honestly a lifesaver during crunch time. All right, folks. Next up is other investment characteristics. In this section, we're going into the statistical side of returns, like normal distribution, standard deviation, skewness, kurtosis. Yep. Don't worry, I'll make it smooth. Stick with me. This journey is just getting started. Now, listen, this section may sound like a side note, but don't let the name fool you. This is core stuff, especially when it comes to understanding the behavior of returns in the real world. It's not just about how much return you're making. It's how those returns behave over time that tells the real story. We'll start by talking about distributional characteristics of investment returns. Now, you've probably heard the term normal distribution before, right? Picture that classic bell curve, smooth, symmetrical, predictable, and in theory, it's beautiful. The mean equals the median, the whole thing is symmetric, and about 68% of your returns fall within one standard deviation of the average. Go 2 standard deviations out, you got 95% of the data. 3, that's 99%. Pretty neat, right? Now, when we say that returns are normally distributed, here's what that really means. The distribution is perfectly symmetric. So the mean, median, and mode are all equal. No skew, no surprises, just a smooth, balanced bell curve. And the real beauty of a normal distribution, it's fully defined by just 2 parameters. The mean, which tells us the average return, and the variance or standard deviation, which tells us the spread or risk. That's it. You don't need anything else to describe the whole shape of it. So once you know the average return and the standard deviation, you've basically got the full picture of how those returns behave, as long as you're assuming normality. And yeah, trust me, the exam loves this stuff. They'll often sneak in a question testing whether you understand that in a normal distribution setting. You might see a question that goes, according to mean variance analysis, and that's your cue. Your brain should immediately light up and say, okay, we're assuming normal returns, and we're living in a clean, efficient market model in a world where markets are efficient, informationally, and operationally. But the real problem? Real world returns are rarely normal. Markets don't behave that politely. So let's go beyond the textbook. This is where we get into deviations from normality. And 2 big ones you need to know for the exam are skewness and kurtosis. First, we've got skewness. Think of it as the lopsidedness of the return distribution. If your returns are negatively skewed, the graph leans to the right, but the tail stretches out on the left. That means more frequent bad surprises, more losses, and the average might not be telling you the whole story. In other words, a negatively skewed portfolio looks fine until something hits you from the left field. Happens all the time in equity markets. On the other hand, if you're positively skewed, that tail stretches to the right. That's the dream, right? Low chance of giant upside surprises. Think of a small biotech stock that mostly goes nowhere, but could 10 times if a drug is approved. That's positive skewness in action. Now let's talk kurtosis, or what we like to call fat tails. This means there's a higher probability of extreme outcomes, good or bad, than the normal distribution would have us believe. And if you've lived through 2008, 2020, or even crypto crashes, you know exactly what I mean. These fat tails can blow past what mean variance models tell us to expect. So what do we do? Well, that's where risk tools like value at risk, VAR, and conditional tail expectation, CTE come in. These help measure the damage when things go really wrong, like worst case scenarios. And yes, CFA exam questions will ask you about these, especially how traditional models might underestimate risk when real world returns are skewed or have fat tails. Bottom line, normality is convenient, but reality is messy. And as a future CFA charter holder, your edge comes from understanding what happens outside the curve. Okay, deep breath. Now we transition to the second big area here, market characteristics. And this is where things get really real because we're talking about what it costs to actually make trades. It's not just about return and risk on paper. The cost of trading can quietly eat into your portfolio. Let's break it down. Let's start with liquidity risk. This one's a silent killer, especially in emerging markets or when you're dealing with low-grade corporate bonds. The idea is simple. If you need to sell and nobody's buying, you're in trouble. Prices can drop fast, or you might not be able to get out at all. Imagine trying to sell a luxury villa in a remote town. There just aren't many buyers. Same thing happens with illiquid financial assets. Then we've got the cost of trading, and it's not just about brokerage fees. There are three big components to know for the exam. First up, the obvious one, brokerage commissions. That's the fee you pay just to make the trade. These are usually negotiable and not too crazy unless you're dealing in very small trades, in which case they start to matter more. But then there's the bid-ask spread, and this one's sneaky. For highly liquid assets like large cap stocks, the spread is tight, but for thinly traded assets, that spread gets wide, and you lose value every time you buy or sell. And then the third one, there's price impact. When a large trade moves the market itself, this one hits harder for large institutional players. If you place a massive buy order, the market might move against you as you're buying, driving the price up. That slippage, that's your price impact. Folks, this is especially important for institutional investors making multi-million-dollar trades. Move too fast, and you push the price against yourself. Lastly, we've got a cluster of other market factors that affect investor confidence and overall transaction costs that might not show up in formulas but still affect decisions, like analyst coverage, like how many analysts cover the stock, how easily you can get quality information, how reliable the financial info is, and even the size of the firm. Small firms, they're the Wild West. Think about it. Would you feel more confident investing in a company that has 15 analysts following it or one that no one's talking about? So big, well-covered firms tend to be more liquid and easier to trade. All right, that wraps up section 3. All right. Now let's talk about something that lies at the heart of every portfolio decision, risk preference. I mean, think about it. Not everyone has the same stomach for risk, right? Some people invest like cautious chess players, others like high-stakes poker gamblers. So when you're constructing a portfolio, whether it's stocks, bonds, or T-bills, your job is to match the investment to the investor's risk-return profile. Otherwise, it's a mismatch waiting to explode. Let's break this down. First up, we've got the classic risk-averse investors. These are the folks who'd rather take a lower but more certain return than gamble on something with big ups and downs. Picture someone approaching retirement. They'd rather earn 4% safely than roll the dice on a 50-50 chance at 10% or 0. It's the core idea behind the risk-return trade-off. More return equals more risk. But not everyone wants that trade. Now, most financial models, including a lot of what you'll see in the CFA curriculum, assume a risk-averse representative investor. That's the baseline. That's who the models are designed around. But then You've got risk-seeking investors. Yep, they actually enjoy the thrill of uncertainty. These are your lottery ticket buyers, your crypto YOLO traders. They might accept a lower expected return overall just for the chance of hitting it big. It's not about rational value maximization. It's about chasing excitement, even if the math doesn't check out. And right in the middle, there's the risk-neutral crowd. These folks, they just don't care about the ups and downs. All they see is the expected return. If you offer them a 5% expected return, they don't care how bumpy the ride is. They're focused purely on maximizing return. In real life, you might find this in large institutional players managing diversified funds. They've got so much capital and risk spreading that they can afford to take emotion out of the equation. Okay, theory moment. Utility theory and indifference curves. Big fancy words, simple idea. We'll explore the mechanics later. For now, think of this as your quick primer. Utility here just means satisfaction. It measures how much joy or value an investor gets from a certain combination of risk and return. Some people sleep well at night with low risk and modest returns. Others need the adrenaline of big gains, even if it means big swings. And we model this with indifference curves. They show portfolios that deliver the same level of satisfaction to a particular investor, even if the risk-return combo is different. And finally, there's risk tolerance. This is a term you'll hear a lot in practice. It's basically how much pain an investor can take to chase a goal. Someone with high risk tolerance might be fine with short-term losses if it means long-term gains. Someone else might panic and sell the moment their portfolio dips 5%. The CFA exam might frame this as like, which portfolio suits an investor with low tolerance but a long-term horizon. And it's your job to apply what we've just covered. So what's the takeaway here? Knowing the investor's risk profile, whether they're risk-averse, risk-seeking, or somewhere in between, is step one in portfolio construction. Because the best portfolio in the world, it's useless if the investor can't stomach it. And remember, this section is highly testable. So, expect exam questions asking you to identify behavior based on return preferences, or to explain how risk tolerance affects asset allocation. You've got to know how to read the investor, not just the numbers. All right, let's take everything we just discussed about risk aversion and zoom in a little closer, because now we're going to explore the why behind those investor preferences. This is where utility theory comes in. And while it might sound a bit abstract at first, I promise you, once you get it, it'll feel like common sense. So here's the idea in plain terms. Utility theory is all about measuring satisfaction. Yep, good old human satisfaction. The more satisfied you are with an investment outcome, the more utility you get from it. That's it. Think of it like this. Let's say you're given a choice between two investments. One has a guaranteed 7% return, and the other has a 50-50 chance of either 0% or 14%. Both of them have the same expected return, 7%. But which one feels better to you? If you're risk averse, you'll probably go for the guaranteed 7% because it gives you more peace of mind, more utility, even though the math is the same. That's what utility theory captures. It bridges the gap between raw numbers and human preferences. Now, this is where indifference curves come back into play. Remember these from the last section? These curves connect all the combinations of risk and return that give an investor the same level of utility. Let me paint a picture. Imagine you're looking at a graph with expected return on the vertical axis and risk, standard deviation, on the horizontal axis. An indifference curve is like a contour line. every point on it gives the same satisfaction. But the higher up you go, meaning the more return for the same amount of risk, the happier you are. So naturally, investors want to be on the highest indifference curve possible while still staying within the opportunity set, the set of all portfolios that can actually be built. Now, let's see how this happens in real business world. Picture two investors. Let's assume investor A is a young tech entrepreneur, high risk tolerance, willing to swing for the fences. Now, investor B, let's say he is a retiree living on a fixed income, super cautious, and prioritizing capital preservation. If you gave them both the same investment options, they'd still choose different portfolios. Why? Because their utility functions, how they perceive risk and return, are different. One wants excitement and upside. The other wants sleep at night safety. So even though the math behind the portfolios is the same, the utility derived from those choices is not. Now, indifference curves come in all shapes depending on risk tolerance. If you're very risk averse, your curves are steeper. You want a lot more return to take on even a bit more risk. If you're more risk tolerant, the curves are flatter. You're willing to stretch further on risk without demanding as much extra return. Here's a quick insight. On graph, the optimal portfolio is where the investor's highest indifference curve is tangent to the opportunity set. That's the point where utility is maximized given what's available. Think of it like shopping. You've got a budget, the opportunity set, and you're trying to buy the combination of goods, risk and return, that gives you the most satisfaction. The point where your desire and your budget perfectly align. That's your optimal purchase. Same logic here. Now, let me explain optimal portfolio choice in a way that actually makes sense. No finance jargon overload. Imagine you're at an ice cream shop. The menu is like the capital allocation line. It shows all the different combos of scoops. Now, those scoops, that's like your risky assets, and toppings, that's your risk-free asset you could possibly get with your money. Now you've also got your own personal happiness meter for ice cream. Let's call these your indifference curves. Each curve is a mix of scoops and toppings that makes you equally happy. Maybe you love chocolate, or maybe you're more of a vanilla with sprinkles person. Here's the trick. The best ice cream experience, the one that makes you happiest for your money, is at the point where your happiness curve just brushes up against the menu line. That's the spot where what you want matches the best combo the shop can actually give you. If you start dreaming about combos above the menu line, like 10 scoops with unlimited toppings, sorry, that's not possible. The shop just doesn't offer it. And if you settle for combos below the line, just one scoop, no toppings, but you could afford more, you're selling yourself short. You could be getting more for your money. So just like with ice cream, your optimal portfolio is the mix of risk and return that fits your preferences perfectly and is actually available to you in the market. It's where your dreams and reality shake hands. That's the sweet spot everyone should aim for in investing. One more thing, folks, utility functions are subjective. There's no one size fits all. That's why portfolio management is both an art and a science. You can't just optimize for return or minimize risk in isolation. You have to tailor everything to what the investor values. All right, let's pause for a moment. Everything you're seeing now on screen, that's from our FinQuiz Battle Ready summary for this section. And trust me, if you want to quickly lock in these concepts before exam day, this is the way to go. The link's in the description. You can also grab our Stanley notes and formula sheet to go even deeper. All right, guys, application of utility theory to portfolio selection. Let's break this down. This is all about applying utility theory to portfolio selection. Sounds heavy? But don't worry. We're going to unpack it in an easy way. So first off, look at the portfolio return formula. What does this really say? Well, it's just telling us that the return on your portfolio is a mix of two things. Simple idea, you're blending safe money with risky money depending on how much risk you can handle. So if half your money is risk-free, W1 is 0.5 and the rest is in the market. Now, risk isn't just about what you earn, it's about volatility. That's where the variance formula comes in. Looks intimidating, right? But here's the trick. Since the risk-free asset has zero variance, all of that boils down to this equation. The portfolio's risk just depends on how much weight you put into the risky asset. If you throw everything into treasury bills, variance is zero. If you throw it all into the stock, your variance is just the stock's variance. Anything in between is a scaled version of that. Next, the capital allocation line, the CAL. This is the star of the show. The CAL is just a line that shows you all the possible portfolios you can get by mixing risk-free and risky assets. Mathematically, it looks like this. It says your portfolio's expected return equals the risk-free rate plus the market's excess return per unit of risk multiplied by how much total risk you choose. Now, this portion right there, that's the slope of that line. It tells you how much extra return you get for every extra unit of volatility you take on. So think about it this way. The steeper that slope, the more return you're getting for every bit of risk you take. If the line is flat, you're barely getting paid for your risk. If the line is steep, you're getting rewarded handsomely for taking on extra volatility. This is why CFA exam questions love to ask about the slope of the CAL. It's not just a line, it's a story about how markets reward risk-taking. All right, deep breath. Because now we're about to mix theory and math in a way that really matters. Portfolio risk when combining two risky assets. Now, I know as soon as we say the word formula, some of you get a little twitchy. But hang in there, I promise. I'll break this down like we're just chatting in a classroom. And folks, this is one of the most important ideas in modern portfolio theory, how risk actually behaves when you combine two risky assets. Let's start with the easy part, portfolio return. The return on a portfolio is just the weighted average of the individual asset returns. So if you put 60% of your money in Apple stock and 40% in Coca-Cola, your portfolio return is 0.6 times Apple's return plus 0.4 times Coke's return. Straightforward, right? Weighted average, no tricks here. Now, folks, portfolio risk is not a simple average. If you have two risky assets and you're combining them into one portfolio, you don't just take the average of their risks. Nah, it's more interesting than that. That's where students often get tripped up. You can't just average Apple's volatility and Coke's volatility. Why? Because risk isn't additive the way returns are. Risk depends on how those assets move together, and that's where correlation comes in. So remember, the way these two assets move together, their correlation matters just as much as their individual risks. The formula for portfolio variance looks scary. Yeah, I know, that's a mouthful, but let's walk through it slowly. Sigma squared of the portfolio equals the sum of all the weights squared times the variances plus the covariance. If we simplify to just two assets, the formula for portfolio standard deviation is the square root of three parts. The weighted risk of the first asset, the weighted risk of the second asset, and finally the interaction between the two, which is the covariance term. Now, those first two parts are just telling you how volatile each stock is on its own. But the third term is the magic. It's what captures the relationship between the two assets. So portfolio standard deviation, in plain English, it says take each asset's weight, consider its own variance, and add in how much it moves with the other asset. If we just look at two assets, the standard deviation formula becomes this. Think of it with a real-world scenario. Imagine you hold Delta Airlines and ExxonMobil. When oil prices rise, Delta suffers because jet fuel costs eat into its profits, but ExxonMobil benefits because it's selling oil at a higher price. Their returns move in opposite directions, which means their covariance is negative, and that negative interaction actually lowers your overall portfolio risk. Even though both stocks are risky individually, the combination makes the portfolio more stable. That's diversification in action. Now, covariance by itself is messy to interpret. It's measured in squared units and doesn't really tell you much directly. That's why we translate it into a correlation coefficient. Correlation is bounded neatly between -1 and +1, and it's much easier to make sense of. A correlation of +1 means the two assets move perfectly together, like Pepsi and Coca-Cola, where sales often rise and fall in tandem. In that case, there's no diversification benefit. Your portfolio is basically just a scaled version of the same risk. A correlation of 0 means the assets have no relationship, like Apple stock and the price of wheat. And a correlation of -1 means they move in perfectly opposite directions, which is the dream scenario for a portfolio manager. With perfectly negative correlation, you can actually construct a completely risk-free portfolio by balancing the weights correctly, because when one asset zigs, the other zags with equal intensity. So what's the big takeaway? Returns are easy. They always combine as a weighted average. Risks are trickier because how assets move together can either magnify your risk or cancel some of it out. That's why diversification isn't about holding a lot of securities that all look the same. It's about holding assets that behave differently. A portfolio of just tech stocks won't save you in a tech downturn, but a portfolio mixing tech with utilities, healthcare, and maybe even commodities can smooth out those bumps. And so, yeah, even if two assets are super risky individually, combining them can actually reduce overall portfolio risk, as long as their correlation isn't too high. Now, the formulas in this section are super important to understand the dynamics of portfolio risk and return. CFA exam loves to throw in some math-based questions like, given weights, standard deviations, and correlation between two assets, what is the portfolio standard deviation? You'll either be solving it directly or figuring out how changing one variable affects the total risk. Now, remember folks, one important point. Diversification helps you reduce risk, but it doesn't reduce your expected return. And that's exactly why the CFA exam loves testing this concept. You might see a question where two portfolios have the same return, but one has lower risk. And the smarter pick is always the one with less volatility, assuming the investor's risk-averse. And you know what else? You'll often see questions testing your intuition, not just the math. Like, which of the following would decrease portfolio risk the most? And the right answer? Usually the pair of assets with low or negative correlation. One last nugget before we move on. This topic is a prime candidate for item sets in level 2. So understanding it now at level 1 is like buying knowledge at a discount. It compounds. You're seeing all of this visualized right now through our FinQuiz Battle Ready summary. See how we've highlighted the equation structure and correlation impact? That's what'll stick in your brain come exam day. If you don't have your own copy yet, links in the description. Trust me, it'll save your sanity. All right, let's build on what we've just covered in the previous section. Remember how we said that the risk of a two-asset portfolio depends on correlation? Well, that exact same principle extends when you've got many assets, 5, 10, or even 100. The big idea doesn't change. The lower the correlation among your holdings, the more risk reduction you get. Now, let's start with portfolio return. Nothing new here. The expected return of a portfolio with many assets is still just the weighted average of individual returns. If you put equal amounts into 10 different stocks, your portfolio return is simply 1/10 of each stock's expected return added together. So returns combine in a straightforward way. But risk, once again, is where things get interesting. The variance of a portfolio with many assets looks like a long equation. It's the sum of the weighted individual variances plus the sum of all the covariances. In plain terms, it's your own assets' volatility plus how they interact with each other. If you assume equal weights, then each asset carries 1/n of the portfolio and things simplify nicely. Now, as the number of assets, n, gets very large, the first term, the individual asset variances divided by n, shrinks toward 0. That means that the contribution of any single stock's variance becomes negligible in a big portfolio. What's left is the second term, which is the average covariance. In other words, in a large, diversified portfolio, your risk is dominated not by the volatility of each stock on its own, but by how the stocks move together. Let's put this in real-world context. Imagine you build a portfolio of 200 US stocks. Adding the 201st stock isn't going to make a huge difference, because by then the individual stock risks have already washed out. What matters much more is the average correlation across your holdings. If all 200 stocks are in the same industry, like tech, their correlations are high, so your portfolio risk remains high too. But if you mix in utilities, healthcare, or maybe some commodities, you're pulling correlations down, and that's where the real diversification benefit kicks in. Now, this formula shows this clearly. The first term, sigma square over n, fades away as n gets large. The second term, which involves the correlation, is what lingers. That's the reason why fund managers obsess over correlations, because in large portfolios, correlation is the main driver of overall risk. So the big insight here is that simply adding more stocks doesn't guarantee meaningful diversification. True diversification comes from mixing assets that aren't highly correlated. If your portfolio is full of companies that all react the same way to market news, you haven't really diversified at all. But if you combine assets with low or even negative correlation, your risk can drop substantially, sometimes close to 0. This is why modern portfolio management is as much about choosing the right mix of asset classes, stocks, bonds, real estate, commodities, as it is about picking individual securities. Effective diversification means minimizing correlations, not just adding more names. So folks, remember, when we move from two assets to many, the same principles apply, just with more moving parts. You still care about expected returns, individual risks, and how each asset interacts with the others, meaning correlation is still front and center. Now, diversification gets even better when you throw more assets into the mix, as long as they're not all highly correlated. The more unique, uncorrelated assets you have, the more that risk smooths out across the portfolio. Think about a pension fund. They're not just holding Apple and Tesla, they're holding US stocks, international bonds, real estate investment trusts, infrastructure projects, maybe even private equity. Why? Because no single asset class dominates all the time. So they spread it out. That's the power of many risky assets working together. And when you move to a portfolio of many risky assets, the portfolio variance becomes a bit messier, but it still boils down to two things: the variance of each individual asset and the covariance or correlation between each pair of assets. It can get overwhelming, which is why in real life we lean on tech and tools like Excel, Python, and risk management software to calculate these things. But for your level 1 exam, what do you really need to know is how correlation affects portfolio risk, how diversification can reduce total risk, even if individual assets are risky. That standard deviation of the portfolio isn't just the average of individual volatilities. Now, on exam, you might be given a scenario with multiple assets and asked, what happens to portfolio risk as the number of assets increases? And the answer, risk decreases, but at a declining rate, especially when the added assets are not perfectly correlated. Oh, and here's a little trick the examiners love to pull. You might get a question that goes something like, which of the following portfolios would most likely have the lowest risk? And usually the right answer is the one that mentions assets with low or even better negative correlation. That's the CFA Institute's way of making sure you've really internalized that diversification isn't just about adding more assets. It's about adding the right mix of assets that don't move together. All right, folks, now we get to one of the most important and honestly one of the coolest ideas in investing, the power of diversion, or simply put, diversification. Now, this is the part where finance feels less like abstract math and more like real-life common sense. At the end of the day, most investors are risk-averse. We don't mind taking risk if there's a payoff, but we'd sure prefer to smooth out the ride and avoid those gut-wrenching crashes. Sometimes we're even willing to give up a little bit of return just to sleep better at night. And diversification is the tool that makes this possible. Now, we've already talked about correlation, how assets moving together increases portfolio risk, and how assets moving differently can bring that risk down. This section is all about turning that idea into a strategy. Let me give you a story. Imagine you put all your money into a company that makes beach umbrellas. Fantastic returns when the sun is shining. Let's say 20% in a good year. But when the weather turns rainy, sales collapse and your return is 0. Average return, 10%. But it's a roller coaster. Sunny or rainy, feast or famine. Now you think, hey, I'll add another business. So you throw in a surfboard rental shop. Feels smarter, right? Except surfboards also sell when the sun's out. When it rains, nobody's at the beach renting boards. So what happened? You added another asset, but the risk didn't go down. Why? Because both businesses are driven by the exact same factor, weather. Their correlation is basically +1. Now let's change the second business. Instead of surfboards, you invest in a streaming service. Think Netflix or Disney Plus. What happens? When it's rainy, people aren't at the beach. They're at home binging shows. The streaming company does great in those conditions. Sunny day. Streaming slows down, but beach umbrellas fly off the shelves. Suddenly, the two businesses move in opposite directions. Their correlation is negative. And if you split your money between them, your portfolio smooths out beautifully. You still average 10%, but now it doesn't matter if it rains or shines. That's diversification. It's not about owning more stuff, it's about owning different stuff. So, folks, correlation is the key. The lower the correlation between assets, the lower your overall portfolio risk. Unfortunately, in the real world, most assets are positively correlated, especially during crises when you need diversification the most. but there are still plenty of ways to find assets that don't move together. Now, let's talk about history for a second. Returns bounce around a lot. Stocks are hot in the 90s, cold in the 2000s. Bonds have had decades of steady returns and decades of disappointment. But risk levels and the volatility of these asset classes are surprisingly stable over time. Stocks are always riskier than treasury bills, and correlations also tend to hold fairly steady. For example, stocks and bonds often have low or even negative correlation, which makes them a classic mix in portfolios. What's changed in recent decades is globalization. US stocks and international stocks are more correlated today than 30 years ago. But even at 0.6 or 0.7 correlation, that's still less than +1, so there's diversification value. This is why professional portfolios don't just hold one type of stock. They mix US large caps, international equities, bonds, real estate, maybe commodities like gold. Each asset class brings something different to the table. Stocks bring growth, bonds bring stability, real estate brings inflation protection, and gold often zigzags when everything else is zagging. So how do you actually diversify in practice? Start with asset classes. Don't just own one flavor of stock. Use index funds or ETFs to get broad exposure cheaply. Diversify across countries like US or Europe or in emerging markets. Because, different economies run on different engines. And don't over-invest in your employer's stock. Remember, you're already invested in your employer through your job and paycheck. Loading up your portfolio with the same company is doubling down on risk. And here's something that usually makes people raise their eyebrows: insurance. Think about it. Insurance is one of the few things in life that actually benefits you when everything else is going wrong. Your house burns down, your car gets totaled. Insurance is the thing that steps in and pays. In finance speak, that makes it a negatively correlated asset. When your portfolio is bleeding, insurance is one of the few assets that moves the other way. The same idea applies to financial insurance, like put options. Most of the time, they just sit there costing you money, like paying your car insurance premium every month, even though you never crash. But the moment the market falls off a cliff, those puts suddenly come alive and protect your downside. Now, that's diversification in a different form. You're basically saying, I'll take a small, predictable expense now to shield myself from a massive, unpredictable disaster later. So folks, remember, diversification is not just about piling up more assets. It's about mixing assets that don't all move together. That's what lowers your portfolio risk while keeping your expected return intact. It's the finance version of don't put all your eggs in one basket. And trust me, this is one of those concepts examiners love to test. Because if you really get this, you understand the very heart of modern investing. All right, now let's get visual. Because this next concept is a game changer for understanding how investors actually pick portfolios. We're talking about the efficient frontier, the investment opportunity set, and something called the minimum variance portfolio. Sounds fancy? Yep, I know. But it's really about answering one simple question: which portfolios give me the most return for the least risk? That's it. So let's start from the bottom up. Let's talk about what this picture is really saying. The curve you see here is called the minimum variance frontier. It shows all the portfolios that give you the lowest possible risk for each level of return. Imagine plotting every possible combination of risky assets on a graph. You've got risk, standard deviation, on the horizontal axis and expected return on the vertical axis. what you get is this big curved shape, kind of like a lopsided bowl tilted to the right. This shape is called the investment opportunity set. Now here's where it gets interesting. Not all the portfolios in that set are good choices. Some give you less return for more risk, and that's just inefficient. So we cut off the bottom portion of the bowl, the part where portfolios are too risky for what they return. What's left on the top edge? That's the efficient frontier. Every point on the efficient frontier represents a portfolio with the highest possible expected return for a given level of risk, or alternatively, the lowest possible risk for a given expected return. That's what makes them efficient. Now, take a look at points X and C. Notice something? They both have the same level of risk, but X gives you a higher return. Given that choice, any rational investor is going to take X over C. Nobody wants the same risk for less return. All right, quick story time. Let's say you're choosing between two portfolios. Portfolio X has an expected return of 8% and risk of 10%. Portfolio Y also has an 8% return, but with 12% risk. Which one would you pick? Obviously, portfolio X, same return, less risk. That's what the efficient frontier does. It filters out the Ys of the world. Now there's one very special portfolio on this curve, the global minimum variance portfolio. This is the portfolio that has the lowest possible risk out of all the portfolios in your opportunity set. It's the leftmost point on the efficient frontier. So if you plotted every combination of assets, the minimum variance portfolio is the one that sits at the bottom left corner of the curve. No other risky portfolio has less volatility. And here's a key exam point. The CFA Institute loves asking, which of the following portfolios lies on the efficient frontier? Or which portfolio has the lowest risk among risky assets? Answer? That's your minimum variance portfolio. So if you see a question like, if an investor selects a portfolio not on the efficient frontier, what does it imply? And the answer? That they're not optimizing. They're either taking on unnecessary risk or leaving returns on the table. Now, let's connect this to what we learned earlier. When we overlay indifference curves on the same graph, the investor's optimal portfolio is where their highest indifference curve is tangent to the efficient frontier. Where satisfaction meets opportunity is the sweet spot. Now, here's a nuance most people overlook. The slope of the curve changes. At point where minimum variance portfolio lies, when you take on a bit more risk, you get a big bump in return. At point X, the extra return is smaller. And by the time you move out to point D, each extra unit of risk barely buys you much return at all. In other words, the payoff for taking on more risk keeps shrinking the further out you go. That's why we say the efficient frontier has diminishing returns to risk-taking. So big picture, the efficient frontier helps investors choose portfolios intelligently, not emotionally. It's the math behind making smart, risk-adjusted decisions. And just to be clear, this is still just within the realm of risky assets. Once we bring in the risk-free asset, we'll move from the efficient frontier to the capital market line. That's coming up next. All right, let's head into section 11, capital market line and risk-free asset integration. Okay, here we go. Let's level up our portfolio thinking. So far, we've been playing in the sandbox of risky assets only. But now we're throwing a risk-free asset into the mix. And trust me, this changes the whole game. Now, first, if you're thinking, what's a risk-free asset? It's something like a treasury bill where there's no volatility and you're guaranteed a certain return. Let's say that return is 3%. Now plot that on the same graph we've been using, risk on the x-axis, return on the y-axis. That risk-free asset sits right on the y-axis because it has 0 standard deviation, no risk. Now, if you combine a risk-free asset with a portfolio of risky assets, the resulting combination doesn't curve like before. It forms a straight line. And this line, it's called the capital allocation line. Now, the CAL, or capital allocation line, it connects the risk-free rate to a point on the efficient frontier. And depending on which risky portfolio you pick, you can draw a different capital allocation line. But here's the thing, not all CALs are equal. Some dominate others. For example, the capital allocation line that runs through portfolio P, the optimal risky portfolio, it lies above the CAL that runs through somewhere around this area. So it means that the CAL at point P offers higher returns for the same level of risk. So rational investors will always prefer the capital allocation line at point P. And this straight line, CALP, actually dominates the entire efficient frontier of risky assets. Why? Because every point on that line gives you a better risk-return trade-off than anything on the frontier below it. That's why portfolio P, the tangency point, is called the optimal risky portfolio. Okay? I hope you got that point now. Let's move to the next section. All right, folks, here we are. Final stretch. We've talked about efficient frontiers, risky assets, risk-free assets, and how they all come together. Now we bring in you, the investor, because this section is all about finding that optimal investor portfolio, the one that's tailor-made for your risk tolerance and your return expectations. So let's wrap this up with the big question. Once we've got our capital allocation line, the CAL, how does each investor actually choose their own portfolio on it? Here's the answer. It depends entirely on risk preference. Remember those indifference curves we talked about earlier? They represent an investor's utility or satisfaction for different risk-return trade-offs. The optimal portfolio is simply where the highest possible indifference curve just touches the CAL. That tangent point is the sweet spot, the best mix of the risk-free asset and the optimal risky portfolio for that particular investor. Now, let's make this real. Imagine a highly risk-averse investor. They don't want much volatility, so their chosen point will be way to the left on the line, close to the y-axis, maybe even 100% in T-bills. A moderate investor, they might land right at the tangency portfolio, fully invested in the optimal risky portfolio. And a risk-tolerant thrill seeker, they'll push beyond that point, borrowing at the risk-free rate to lever up their exposure. That puts them further out on the line, chasing bigger returns with bigger risk. And here's the beautiful part. This entire process is explained by the two-fund separation theorem. Sounds fancy, but the idea is simple. No matter who you are, cautious grandma, balanced retiree, or aggressive hedge fund trader, your portfolio can always be built from just two ingredients, the risk-free asset and the optimal risky portfolio. Everyone shares the same optimal risky portfolio. What changes is just how much of it you hold versus the risk-free asset. Oh, and here's a key point. Anything above the CAL is unattainable, doesn't exist. Anything below the CAL is suboptimal. No rational investor would settle for it. So the only portfolios that matter are right there on the line. So the takeaway? The efficient frontier gave us a menu of risky portfolios. Adding a risk-free asset gave us the CAL. and indifference curves tell us which exact point on that line each investor will pick. In short, one line, two funds, infinite investor solutions. All right, folks, let's lock this in for the exam. What's this whole section really about? Let me spell it out one more time so it sticks. So, the capital allocation line is king. It dominates the efficient frontier of risky assets. Every investor ends up somewhere on that line. What's different is not which risky portfolio you hold. We all share the same optimal one, but how much of it you combine with the risk-free asset. That's the essence of the two-fund separation theorem. Now, think of it like this. If you're risk-averse, you're hanging out on the left of the line, heavier in T-bills. If you're moderate, you might be right at the tangency portfolio. And if you're aggressive, you might even borrow to push beyond that point, taking on more risk for the shot at higher return. But no matter what, your portfolio is always somewhere on that one straight line. So for the CFA Level 1 exam, remember these golden rules. Anything above the line is impossible. Anything below it is inefficient. Only the line itself is efficient. That's the picture you need in your head on exam day. Risk-free rate on the y-axis, the tangency portfolio on the curve, and that straight line shooting out, the CAL. If you can visualize that, you'll crush any question they throw at you. And big picture, this isn't just exam material. It's the logic real investors use every day. Keep that in mind, stay confident, and you'll walk into the exam knowing you're already thinking like a CFA charter holder in the making. So, everything we've covered, from risk aversion to diversification, from efficient frontiers to the capital allocation line, boils down to one central idea. Smart investing is about balancing risk and return. Diversification reduces risk, correlation shapes portfolios, and once we add a risk-free asset, efficiency is captured by a single straight line. All right, team, take a deep breath. You made it, and wow, what a journey. And if today's session helped, check out the full suite of FinQuiz tools: battle-ready summaries, Stanley notes, the formula sheet, our intensive question bank, and those must-practice mock exams, all designed to push you closer to your goal. So keep grinding, keep believing, you've got this, and we'll see you in the next video. Let's keep that momentum going.